Has anyone had any Messina today yet? Or is it not open? It's probably not open yet. It's still probably a little bit early. All right. Well, I just wanted to say welcome. I hope everyone had a really nice morning tea. A big shout out to our sponsors, K&L Gates, for their contribution to it. So we have our next panel, which is Building a Sufficient Runway Before Liftoff, Securing Funding in 2025. So please help welcome the panel to the stage. Sorry, I obviously haven't had enough coffee again today. So let's give them a round of applause. So I'm going to introduce our moderator, Kenneth Lau, from Director of RSM. Sorry, I think I really need that coffee. But I'll hand it over to you to take it away.
All right, thanks. And good morning, everyone. And welcome to this session. You definitely picked the best one to attend, so thank you. As founders, investors, and advisors, we know that the path to growth is rarely linear. So today's conversation is about what it takes to prepare for that critical moment and how to build resilience, attract the right capital, and navigate the funding landscape. All right. So whether you're here to share insights, ask questions, we hope that this will be a very open discussion, full of energy from the room. My name is Kenneth Lau, and I'm a director at the Corporate Finance Division at RSM. RSM is an accounting firm that focuses on providing solutions to the mid-market segment. And joining me today is Seamus, Group CEO of Zai Payment, Jody, founder and CEO of Tractor Ventures, and Caroline, co-founder and CEO of Hello Clever. And I think I'll just give everyone, take a moment for everyone to introduce themselves before we start the session.
All right,
Seamus.
I'll go first. So my name's Seamus Hodgson. As Kenneth says, I'm Group CEO at the Zai Payments Group. That's two businesses, one that's based here in Melbourne, which is Zai. It's a payment orchestration platform. The other one, while it inconveniently is based in Dublin, which is called Currency Fair and is a cross-border payments business. My career has been in two halves. First half of my career was working for sort of large blue chip organizations like IBM and Aviva. The second half, from 2008, has been in FinTech. Whether that's in credit businesses, FX, payments, or indeed payments orchestration now. My experience of funding has been significant, whether that's been raising capital for businesses or raising money to lend out to clients. So I've seen the cycle several times since 2008, as I'm sure some other people in the room have. So really happy to be here and talk about my experiences.
Hi everyone, I'm Jody. I'm CEO and co-founder at Tractor Ventures. Also been around for a while. My first tech startup was in 2011. We started a marketplace that I sold to Airtasker in 2014. So Tractor Ventures is my third business, and we exist to provide non-dilutive capital to founders. So far, we've deployed over $100 million to 250 companies. We're nearly 5 years old, and those products look like loans. Think of them as a business loan. So, there's a range of them, and really, my thing has been helping to educate founders on different types of capital that you can use and should use at different times for different things. And I brought some money with me. So if you want to chat after this, I've got some. Looking forward to the conversation.
Hi everyone, my name is Caroline Tran. I'm the co-founder and CEO of Hello Clever. So Hello Clever is a global financial technology platform that empowers businesses across multiple markets. We're live in 20 markets right now. Started in Australia in early 2022. We are a venture capital-backed business with now a team of 60 employees globally. Basically what we do is all about payments, APMs, cards, real-time payments across Australia, Japan, Southeast Asia, and soon to be in the US. The journey has been really interesting for us as well, as myself being the first entrepreneur. This is my first business, so it's really great to share more insights about how we start out and raise our capital for our business. So great to be here. Thanks everyone.
Thank you, everyone, for the introduction. I think the way we'll work is that we get the panelists to share their thoughts, and then we'll leave plenty of time at the end for Q&A, if that works for everyone. I think to kick things off, Seamus, probably the fintech sector has seen a major funding slump during the COVID era, and then we see this boom of fintech businesses during the COVID era, and then now capitals are starting to flow back into the segment. What are your thoughts on what are the new benchmark now for what you call fundable fintech?
Yeah, I think the benchmark has definitely changed. I'm sure people in the room remember, and I think about this as pre-COVID, post-COVID. So people in the room will remember pre-COVID, where growth seemed to be very important to investors. Growth at all costs. I think that's definitely changed. I think the benchmark now is disciplined growth, and I think what investors are looking for. One of the main things is the P word. We were talking about this earlier on. Profitability, or at least a path to profitability. I remember funding rounds pre-COVID where investors weren't necessarily particularly focused on how to get to profit. It was all about top-line growth. I think that's fundamentally changed. So I think what makes something fundable is a executable, demonstrable plan to get to profitability in some stage. I think there's also something about capital efficiency. I think investors these days are asking more and more about what are you going to do with my money? And again, pre-COVID, I was part of funding rounds where they weren't particularly interested. They saw a top-line growth number and they were pretty happy to fund you on that basis. But I think that smart investors now are really interested and want to see demonstrated what that capital effectiveness strategy looks like. I think there's also something, investors are also looking for governance within businesses as well, particularly in the fintech sector where a lot of businesses are regulated. They want to make sure that they are investing in a business that isn't going to get caught out. I think they are still looking for innovation, but actually I think that's slightly further down the hierarchy of investment than it used to be. So profitability, we were talking earlier on, and it's the old phrase that revenue is vanity, profit is sanity, and I don't think that's ever been more front of mind for investors in the market as we get into 2025.
Thank you, Seamus. Caroline, what about you? Any thoughts?
Yeah, I feel like this question is quite relatable to our story here. So we raised our first capital during COVID's era, and the requirements is so much different to what you are raising capital right now. So back then, investors only need to know what is your products, how do you go to market, who are the founding teams, what sort of strategy, how you're going to make your first penny, right? But right now, a lot of questions around your key defensibility. Like, what is it that you're different to your competitors? Because, so for example, Hello Clever, we are a payment business, right? So what sort of, products or what sort of go-to-market strategies that make you stand out from the rest of your competitors? So that is really key component to determine for investors to be able to invest into your business. Another way that I could see is that investors are asking for exit strategy. So they ask right away, all right, we're going to invest you right now, but how are you going to be able to give us maybe later on an exit that can give our funds a return on investment? So this applies to VCs across Australia and globally, not just obviously Australia itself. So I see a lot of questions on if you're raising your Series A now, how are you going to get your Series B later? So that has to be around clear pathway to, yes, revenue first mindset, also clear go-to-market strategies, and how you can capture market shares across multiple markets that now you're saying you're doing. So I think it's so important for businesses to be able to, build products, but also have a clear pathway to profit, clear pathway to exit strategy later on.
Thank you, Carol. Jody, how about you? You've been on both spectrums as a business founder and now as an investor. Maybe put on your investor's mindset, and what do you see as the sort of requirements of your investee company?
Yeah, so we launched during COVID and in December 2020, and the reason we wanted to create Tractor Ventures was because not every company is a rocket, which is the VC model, and rockets are exciting and some of them land on the moon, but they're also very expensive and a lot of them blow up along the way, and we've seen that through all of our ecosystem roles as well as our own experience. And so we wanted to bring another type of capital into the mix, and in 2020 going into the start of 21, founders were very curious about what is this funding, how do I use it, how do I think about it. In 2021, when the equity markets tanked and suddenly the whole VC landscape shifted, founders came to us saying, how do I get it? So like our timing was amazing. And so, yeah, I think now we fund companies that are not yet profitable, but we're looking for that unit economics and that path to profitability for sure. And mostly they have that. They know how they're going to get there and they're nearly there. They just need to keep investing. The other thing we're often funding is founders that are in between capital raises and they don't want to dilute heavily. They know they have to dilute again, but what they want to make sure is that they get their valuation as high as possible. So when you're putting money into revenue generating activities, you're going to have that higher top line, you're going to be closer to profitability, and then when you go and raise capital again, you're going to get a better valuation. And that's so important because if you are on that journey of raising, you're going to be diluting over and over and over again, and you want to still have something left for yourself by the end.
All right, thanks, Jody. Probably then the next topic is that, how do you design a runway for your business, between, say, the first investment to the next investment, as well as, how do you balance the mantra between, growth and, survival?
I tend to look at runways rather than as timescales, although they inevitably are, more about milestones. So if you're designing a runway, it's about milestones because hitting milestones give you the ability. One of those milestones might be breaking even, which sends you in a certain direction in terms of your funding. One might just be you're in a position to go back out and find sympathetic investors because you are hitting those development points in your business plan. I think on the question of sort of growth and survivability, it's always a balancing act. It's absolutely a balancing act. And I think that anyone who has either started a business or scaled up a business recognizes you need to have that adaptability. Part of that is driven by existential factors. Part of that is driven by the business plan that you should have in place and you should be sharing with your investors in the first place. So I don't necessarily think that it is a choice between growth and survivability. I think I come back to this phrase, disciplined growth. If you've got the metrics in place, if you have the plan in place, and if you are focused on milestones that either allow you to break even and function without further funding or access further funding to allow you to continue to grow the business or develop it, I think that's what's probably more important in terms of thinking about a runway. If you think about it just as a set of time, chances are you're not going to be managing your burn in the right way and you'll bump into problems later in the runway, I think.
Okay, great. Caroline, anything to share?
Yeah, so I think, starting from having financial discipline from day one is super important. So obviously, before Hello Clever, I was an accountant, so everything's numbers is so important to me. So Hello Clever, we raised more than 10 million to date, and we wanted to always, utilizing our capital like the most efficient way, right? So for example, we do scenario plannings. So basically, as a business, how you can put out a financial projections that give you the best case, the base case, and the worst case. What I'm going to do with the worst case, and what if I run out of capital? What's going to happen? And what if the best case, right? And the base case, so it's for that. So it's super important to have, I guess, governance in the business as well to make sure that you're not thinking about, yes, I'm going to invest capital to try to grow at all costs, especially during this time. Capital is so expensive. So be able to kind of, invest your capital to generate revenue, right? So if I invest $1 into, this kind of particular activity, how I'm going to get the revenue back on it, right? So that is sort of, I guess, the mindset that we have in our business. And we've been profitable. So last year we were profitable. We're Australia's fastest growing fintech. So it is something that we always wanted to have from day one and to make sure there's always, I guess, financial planning in our business.
Okay, thanks, Carol. Jody, the next one is probably for you, and you touched on briefly earlier on. We know that not every fintech will fit the venture capital mold. Maybe if you could share what would be a typical funding structure for fintech, and what do you see as an alternative emerging trend coming along?
Yeah, I think every single business is unique, and so every founder's unique. Everyone has different dreams and plans, and I always talk to founders about where do you actually want to get to with this business first? Like, where are you going? What's your ideal? Like, do you want to ring the bell at the NASDAQ and have gone on that journey, or would you be stoked if you sold the business for $50 million and went sailing for a year? Like, you know, what is it actually that you want, and what do you want to sacrifice on the way? Because there are a lot of sacrifices on the way to the moon, and you know, the risk of not getting there. So I think you've got to sort of work back from what you actually want to achieve in your business, in your life, for the stakeholders, and then map what type of capital you need. So yeah, I think for us, we talk about working capital a lot. To the previous question as well, you know, sometimes you need working capital because you've got bumpy cash flows, things are tight, you are really just managing through, and sometimes you need growth capital. And so I'm talking a lot to founders at the moment, like if I gave you $1 million, what would you do to grow your business? And because sometimes we get stuck in that BAU, that grind, that keeping the lights on, that we forget about if we put in a bit of extra capital, what would that actually do for our business to grow it? So I think there's no one path.
All right, thanks, Jodie. I think we've got about 10 minutes left, so we will be opening questions to the floor. So if anyone has any questions. No question?
That's good.
So if you're saying, let's say you need 10 million to get going, and someone has $1 million to offer you, and they're like, what are you doing with $1 million? Do you need a specific financial runway for their $1 million? Yes. Or just the whole 10?
Yeah, so the question is, if you have $1 million and investors would definitely ask you what you're going to do with this $1 million. So in the deck or in your financial planning, you need to actually tell the investors that, yes, I'm going to use this for product development, I'm going to use this for sales, I'm going to use this for marketing. So the more specific you list out what you're going to do $1 million, the better. And how you then generate, if you're just starting out, then how you're going to generate another $1 million of revenue, right? Because it's geared to investors the confidence for them to be able to see your future financial projections. So the more specific you are, the better. Yeah, so we raised our first seed rounds more than 2 years ago. So we raised 4.5. Specifically, you have to tell them like, right, you know, this is money. The money is going to be in a bank account, and how you're going to generate, you know, your revenue in the next 12 to 18 months. Because you always raise when you don't need money. So you don't raise when you need money, because then you have that sort of like negotiating powers with the investors. Yeah.
I think that's changed from the historical model as well. Even minority investors are really interested in what is happening with their slug. Where certainly historically you used to look at it more as an aggregated amount. My minority shareholders and investors are really interested in what's happening with their money. And so that capital efficiency question is asked even with the minority shareholders as well as people who are putting bigger slugs into the business. And that's only increasing. I think that sort of level of inquiry from investors is only increasing.
Yep, go ahead.
Yeah, great question. Thank you. We think of things very differently to a VC or an investor. We're looking at how you're going to pay back this money, and our loans range from 3 months payback to 5 years. And so we don't mind if you haven't hit the milestones. You don't even need to tell us what the milestones were and where you hit them. What we're looking at is the business fundamentals. Ideally, you've got some runway, 3 to 6 months still in the bank. You're not leaving it to the last minute. You're not calling up saying, God, I can't make payroll. Give me some money. But yes, VC expectations on milestones are so high that it's quite often you don't hit them. And so that's where it's, you know, perfect for us. Like, we'll definitely help you give you that money to see you through until you start getting that extra revenue in. So yeah, we're just looking at, the unit economics. You don't need to be profitable, don't need to have massive growth. Just, is this business going to be able to pay back this money is kind of our lens.
Yep. That's a question. All right, there's one right here.
Thank you for your time. The question is on the price sales. So the price sales cycles into, say, tier ones, tier twos can be very elongated, particularly for a small company going through the hurdles of selling into, say, a tier one, tier two, which might be. So what is your advice for getting sufficient funding to absorb that sales cycle so that you can generate sufficient ARR for a seed, etc.? Because there's views that you might need to generate a certain threshold for seed, obviously elongated sales cycle, or do you kind of get that money up front to allow you sufficient resources, etc.? Take your advice on that.
I think it's different for every business. So I think it comes back to setting out your plan in a really well-developed and articulated way. I think the point on scenario mapping is really clear, because however you think that plan is going to be executed, it won't. There'll be issues that rise up. In terms of when you get the money and whether you front load it or not, I think it again comes down to the appetite of your investors. Every business is different. Sales cycles are different. I've got 2 members of my sales team in the room. They always tell me sales cycles are different. You can't necessarily predict them. So personally, I like to have a buffer in the plan because issues will arise. I don't think that mapping a plan against your predicted sales cycles is necessarily a smart thing to do. I think a buffer is important. But every business is different. To me, it's articulating that plan well enough to your investors so that they can support you on that journey as well.
And you're going to be confident in your plan, right? So because your product is a long sales cycle product, you'll be able to, I guess, identify where is the point that you'll be able to generate that forecasted revenue. And, I guess as well as, trying to find the low-hanging fruit, the best low-hanging fruit you can get out there. Because obviously for Hello Clever as well, we serve merchants from like small to enterprise, right? And we're always trying to find how we get like the best revenue in our business like as quick as possible. And don't bet on products that you think that's not going to be able to generate revenue like immediately. So I don't think it's a good idea. So there has to be diversity in your strategy, and you have to be able to demonstrate that to the investors.
Any other questions from the floor?
How much detail do you need for these financial projections and investment?
Yeah.
It's conceptual. So where's the
Assumptions. Yeah. So I think it has to be. I think investors normally will ask for 3 years planning, and the assumptions normally would come from, again, your products. What are sort of the conversations that you've been having with your potential customers, and obviously they don't expect it to be 100% accurate, but it has to be as detailed and making sense as possible. So for pre-seed companies, and even in our case before, we did a really basic, I guess, financial planning for 3 years. This is the product we're going to sell in the market. This is what we're going to launch. And only need to raise the money that you need. You don't over-raise. Like if you need, let's say, $1 million, don't raise $5 million because it's going to dilute you a lot, right, for future rounds. So I guess, definitely have to be around detailed financial plannings, but it depends on your business strategy and business, scenarios as well. Yeah.
I also think investors are just, no pun intended, investing more time in understanding the industries and the businesses that they are investing in. I certainly had funding conversations pre-COVID, and it was clear to me, even when money was being offered, they didn't really understand the sector that I was in, they didn't really understand the business, and therefore, whilst they were after detailed assumptions, their positive challenge of those assumptions was pretty thin. Experience now in 2025, I think people are really investing the time in understanding the sector or the business that they are in, and therefore being more informed about the assumptions that they are being presented with.
Thank you. Any other question? We probably have chance for one last question.
you. What have you found in your experience is the difference, benefits, challenges of raising in Australia versus raising internationally?
I think the challenges are probably the same. I think that whilst each country, so I've operated in the UK and Australia, the US, my current largest funder is based in Singapore. I think there are some universal truths to the process. I think the challenges to me are more around where we are in the cycle. So I think what I see in Australia, I absolutely see in London. Sometimes maybe one country is following the other. I think the US has a separate set of challenges. I think the tech funds there, the VCs are there in a different space, maybe to Europe, Southeast Asia and Australia. But they were the first to the table talking about profit. They were the first people who were, no. A lot of people that I'm speaking to at the moment won't even entertain, and this isn't sort of seed or at VC level, won't even entertain funding someone until you have a track record of profitability. 5 years ago, that was an anathema. So I think the States is sort of slightly ahead in the cycle, but there is a universal quality, whether you're in London, Sydney, Singapore, wherever. The pain feels the same, but so does the success as well. So.
Maybe I could add I can share a story on that as well. I'm currently working with a health tech business who is trying to revolutionize the NDIS sector. And that is a very local, Australian specific sector. And they were able to attract investment from Singapore and from the UK as well. So, I think as long as your product is good, it makes sense, it doesn't stop you from attracting overseas investment. All right. So I think that's probably the end of the session. Thank you, everyone, for attending the session. And on behalf of RSM and Intersekt, we would like to thank the speakers for sharing their insights, as well as to all of you for your engagement and your question as well. Thank you.
Thanks,